Hi, everyone.
Great. I forgot that you had to redo the chatty thing. Okay, good. All right. Hey, everybody. This is Kelly Olczak, and thank you for joining us. We're going to give it maybe one more minute to let other folks join us, and then we will get going. And I see Bill Bond is on with us. And Bill, I'm glad you got that link. I'm sorry, I did find out that the replay link was broken. I fixed it. But I emailed it to you, just so you know. Okay, so we're going to get going. So today we're going to talk about lots of fun stuff, how tax planning changes through your stages of retirement. And we're going to start it off with a little bit of a brain teaser. Oops, maybe. Hang on. Oh, I got the wrong button there. Cool. Okay. So we're going to start talking about our friend Bill here. So after working quite a while through his adult life, Bill is 65 years old. He's finally retired. He's going to get to more concerts than ever before. He's got a taxable income of about $48,988, which includes $37,500 in Social Security benefits this year. As you can see, Bill's $48,988 of taxable income puts him in the 22% tax bracket because it's more than $47,151 and less than $100,525. Toward the end of the year, Bill decides to take out $1,000, an extra $1,000 from his IRA, so that he can go see Willie Nelson play in Austin. So here's the brain teaser. How much is the extra tax that he's going to pay on the $1,000? Some would say 22%. That makes sense, right? No, he's going to pay $407 in tax, 40.7% on that extra $1,000. Thank you, crazy US tax code. The unique formula that determines how Social Security benefits are taxed are what's coming into play here. And so we are going to pull this apart a little bit later in the presentation, but this is one thing that drives me nuts about our tax code is that extra $1,000 that Bill took out to go to see Willie Nelson really increased his taxable income or taxes. So anyhow, thank you very much for joining us today. I am Kelly Olczak, and I am the managing partner of Lindley & Company. We manage the finances for a handful of families in the area. Oh, sorry, and I've got a tickly throat, so I'm going to be a real treat today. Our firm is 100% woman-owned, registered investment advisory firm. We're based out of the Pittsford area in the Bushnells Basin. We are proud to be fiduciaries. I'm a certified financial planner, and I've held my designation since 2009, which is totally weird. Joining us today is my partner, Becky Gillette, who is also a co-founder and our dedicated chief compliance officer, as well as Chaz Miller, who is our operations manager. Chaz is going to be our moderator today. Sorry. And she's going to help us with a handful of things, including the chat function. If anybody has a question, please feel free to add that question to the chat function in Zoom so that we can be timely in answering your questions. And Chaz will keep me honest on that, as well as our little survey that polling questions that we're going to use to start the presentation. The reason I'm doing this is because I want to understand who is joining us. There's a handful of you that I do know, and there are a couple that I don't. So Chaz, could you launch that for us?
There is part one. There's 3 questions. I'll leave this up for just a little bit so you guys have time to read through the answer options. And we very much appreciate your participation. Thank you. We got a couple so far, but I'm going to do like another 45 seconds.
Cool.
Great. And I will end that now and share.
Terrific. This really helps me understand who's listening to our discussion today, so I can kind of pivot if I need to. Chaz, will you do the next one? And this one's super, super quick, guys.
Yes. And here is part 2.
That one's probably pretty quick, right, Chaz?
Yeah, none. Oh, we got one so far. Just give it another second. Probably more than a second, maybe like 20 seconds. Great, thank you so much.
Great. Terrific. This is great. Just see what people said. Creating trusts. Yep. Okay. And best way to play catch up. Thank you, John. Thank you, Atul. Great to see you, Atul. Okay, so let's get back into it. All right, that's super helpful because that way I will, it doesn't look like we have any, well, we've got one business owner. All right, so let's get going. So we are going to cover a lot of information, and this is being recorded. And so at the end of our presentation, we're going to post this and share the link if you want to rewatch it. And a couple things really important. Everybody's tax situation is very different. And I do not provide tax advice. I'm a certified financial planner. What I try and do is I help people understand the tax codes and how it could impact your financial planning, investments, retirement. I do collaborate with tax preparers and CPAs because they know more about this stuff than I. So I'm just barely dangerous. Couple things to understand while we're talking through these points. There's different kind of retirements accounts, pre-tax accounts like your IRA or 401k. Those investments, when you take money out of an IRA or 401k, all of the distribution has to be taxed. Whereas a Roth, all of those distributions come out tax-free. And then, of course, I think everybody here is from New York, so we're not going to dig into the state side of things. That's where that tax professional comes into play. Okay, so the tax code has changed, which is a joke. It always changes, but there have been some recent changes with the Secure Act. And our goal here is to help you understand the ways to set up retirement distribution so that I strongly believe that our job is to help our clients pay the lowest amount of taxes across a lifetime. And so what we're going to talk about are things that you can control. And when you're in retirement, you may not have the child tax credit anymore. Since the changes of the tax code, we're not allowed to deduct things like mortgage interest and things like that. If you have a 401k or an IRA, that's really where we're going to start talking about distributions. But also now the other thing is required minimum distributions used to be 70 and a half. And for a lot of people now it's 73, even 75. So we're going to kind of wrap our brains around some of these concepts. And again, feel free to send us a little chat if you want us to clarify anything. Okay, so we're going to cover 4 things. This is the first one. People often pay more in taxes than they expected because they don't understand the tax rates and the various ways that distribution income can affect your tax rates, both in an IRS perspective, but also for Medicare. We're going to touch on that. Probably many of you, I know Bill Bond is retired, one of our attendees, but probably majority of you are still adding money to your savings, which is called the accumulation phase. But once you retire, now you're in the distribution phase. You spent all your life trying to figure out how to save enough, and taking money out is weird. Okay. So what we're going to do is help you understand and make informed decisions about the implications of tapping different flavors of accounts, ones that haven't been taxed before, ones that are tax-free in distribution, and regular everyday distribution, like from a checking account or a brokerage account. So because your tax exposure will change throughout these 4 stages we're going to talk about, it's important to have a strategy so you can anticipate both the traditional taxes and the possible taxes, the surcharges that can be applied, or penalties that relate to Social Security, Medicare, and other income sources. That means you'll need a proactive plan to help you address that. So that's what we're going to touch on. My goal is to introduce you to some of these ideas and maybe help you start a strategy for distribution. The first step is to understand the types of taxes that you face. And what do I mean by taxes? I'm talking about all the costs that can increase your income, and then some penalties that aren't actually taxes, but like your premiums on Medicare could go up if you don't have a really good strategy. Oops, hang on. Did that change? Yeah, okay, sorry. All right, so here are the 4 phases of retirement. The the first is that pre-retirement age, 50 to 60, you're still saving, you're working. The next early years of retirement between 60 and 70, call those the go-go years. People are often have grand plans to travel and volunteer and new hobbies, maybe even working part-time, spending more time with their families. The next phase is like between 70 and 80. Things might be slowing down there, which bring on more financial decisions, especially around required minimum distributions. Finally, in the later years, maybe your health is not doing so great. So we're thinking again of making sure that you are cared for and you're maybe addressing some of your legacy and estate issues. And so there's a wide range of issues that must be planned for in each one of these phases, and we're going to cover those. Okay. So as you're probably assuming, there's a lot of surprises in retirement, and we like to sort of have an idea of them before, you can't expect everything to know everything, but we're hoping that we can plan for things like inflation, not outliving your money. 30 years ago, the cost of a gallon of milk and a gallon of gas are very different than now, as we all know, especially lately with such high inflation numbers, which are coming down. But then the next thing is you don't want to outlive your money. And people tend to underestimate how much money they need to maintain their pre-retirement standard of living. I'd rather see you have the same kind of standard of living. And sorry, guys, I'm so congested. I'm a mouth breather. So we want to have maybe even a better standard of living, do more fun things after retirement. But then there's healthcare, and that's the 10,000-pound gorilla. So we're going to touch about that. There's a lot of out-of-pocket payments that you may not have in your plan. And of course, those costs are always rising. So you might say, okay, what's the first thing I need to understand about this? Well, okay. You have to know what your after-tax retirement savings picture looks like before you can actually retire. And this is something I absolutely love to do. I am the most optimistic person you'll ever meet until I start doing financial planning. And then I am negative Nancy, because I want to poke holes in things like unexpected expenses and setting up buckets of money for taxes and home improvements and stuff. So I really try and create an understanding with the client on what do you want to be when you grow up after taxes. So we're going to have a lot of stories during our conversation here around people that might be like you guys. So for instance, in this situation, if you have $500,000 in your 401k or your IRA, it really isn't $500,000 because of the taxes that come out. And the government will start to push you into taking money out when you're 70, 73 or 75, depending on your age. And so at that point, you may not need to take a ton of money out, but they start making you take it out. And therefore your taxes are going to be higher because you're maybe in a higher tax bracket. So that's why your $500,000 might be worth less than you think. So here's the example. It's a chart showing the cumulative after-tax values of $500,000. We're assuming in this this slide that you're getting about a 6% return per year at various tax rates. You'll see a 0% tax rate, 12 and 33. It's simple in theory, difficult in practice. This presentation applies to both pre-retirees and retirees. So don't worry if you're already started retirement. Tax planning is so important throughout your retirement. So now you might say, okay, my accounts are not worth as much as I thought, but I'll have a steady flow of income with Social Security. And I'll have my Medicare to pay for healthcare costs. But the one thing that we need to understand when creating your retirement strategy is Social Security and Medicare have their own tax traps that we need to plan for. And that goes back to our friend Bill. All right, so here we go. Social Security and taxes. Let's go back to Bill. We want to understand why he paid such a high rate on that extra $1,000 that he took out. So Bill had $40,000 in IRA income. Part of his adjusted gross income of $65,538. $37,500 of that amount is from Social Security. So that kind of puts him in a 22% tax bracket, and he takes the standard deduction. Yet, when he took the extra $1,000 out of his IRA, he got hit with a 41% tax rate, $407. So let's kind of break that down so that we can see how this actually happens. First, let's remember the only difference between our two scenarios is that Bill took out the $1,000. That's the only difference between the side-by-sides. So what we see here, that by adding that $1,000 of actual income, it increased his adjusted gross income and his taxable income by $1,850. That means for every dollar of income he actually received, he was taxed $1.85. How? Here's the deal. Depending on how much other income you have, your Social Security benefits, how their tax differs. Some people have no taxable Social Security because they don't have any other income. Sometimes it's 50%, but on the high end, it's 85%. Sorry, I should have put that on D&D. Okay, I did that. So Bill finds himself in that latter scenario where he's at that 85% taxable Social Security amount. And by adding that extra money, he gets whacked. If you added up that $1.85 taxable at his 22% rate for every dollar of additional income he actually receives. But if you do the math on that, it really comes out to 40.7% on that extra $1,000. And what we call this is the Social Security tax torpedo. It can impact single filers as well as married filing jointly couples as well. Any questions so far? This is a lot of information, so I don't expect you to get all of it right away, and that's why we are recording this. Okay, so let's look at some different retirement approaches, specifically focused on Social Security. So now during those go-go years when your people are completely retired, and then sometimes people are semi-retired, so they might have a part-time job. And so working in retirement can impact your planning and your taxes, and sometimes it's good and sometimes it's bad and sometimes it's kind of ugly. So let's look at how working during these years can be a good thing. Chances are, if you're close to retirement, you're starting to research your Social Security benefits, and people decide to take their Social Security at different ages. But let's just go to the basics. Your Social Security benefit is calculated over the 35 highest years of earnings. Those earnings are adjusted for inflation. So I don't know if you've ever gotten your Social Security statement. On like the third page on the inside, you'll see every year what you earned. I went back and looked at I think I had my first job when it was 1983, and I made I think $1,200 that year. They inflate that number to today. So it's not, maybe it was $800. But what you want to know is that if you started working late in life, like my mom stayed home with the kids, and let's say she only had 28 years of work, the other 7 are big fat zeros. So working longer gets rid of those zeros, which increases your Social Security benefit. Now let's look at how working during your go-go years. So after you retire, you might have a part-time job. And let's assume that you took your Social Security before your full retirement age. So in 2024, you can work part-time, take your Social Security early before your full retirement age, and earn up to $22,320 without Social Security taking anything away. So keep in mind, we're talking about earnings. Earnings are a W-2 salary, or if you're self-employed, self-employment income. It does not include pensions or interest, dividends, or capital gains. So for instance, let's say you earn $24,320 in 2024, and that's $2,000 over the limit. Therefore, under the $1 withhold for every $2 earnings rule, Social Security would withhold $1,000 of your 2024 benefit. Now, don't freak out, because that doesn't mean that those earnings are lost. Once you hit your full retirement age, that benefit will be adjusted back to you. But I have one husband and wife. He's an engineer, and he's at full retirement age. He's going to start his benefit right now. And she is 62, and she only makes 19,000 and change every year. So it makes perfect sense for her to turn her Social Security on, because she won't be penalized. But if she made more than that 22,320, for every $2 above that number, they're going to withhold $1. Any questions? These are fundamental to our conversation as we move forward. So now let's talk about the ugly, okay? We're here today to talk about taxes and retirement, but there are other taxes that you face too. For instance, while you're working, you're subject to 7.65% Social Security and Medicare taxes in addition to your income tax. If you're self-employed, that doubles to 15.3. These taxes don't go away if you're working past full retirement. So you're collecting your Social Security and you're taking your W-2 income, and so you are being taxed at that bracket as well. Okay, let's talk about Medicare and taxes. So there's this thing called IRMA, I-R-M-M-A. And this is something that not many people realize until they're in retirement. So IRMMA, or IRMA, stands for Income Related Monthly Adjusted Amount. And the emphasis is on income, because it is a monthly tiered surcharge, again, a kind of tax, that is tacked on to people's Medicare Part B and Part D premiums. But it only happens if you're single and you have income of over $103,000, or if you're married, $206,000. So let's take a look at what this means in action. So here's George and Martha. They're high-earned married couple. Both are Medicare Part B and Part D participants. Their IRMA surcharges affect income from 2 years prior. And this customer was on track for $322,000 of modified adjusted gross income. And they call that MAGI, M-A-G-I, for 2022. But on December 1st, 2022, George decided to sell $10,000 of a stock on July 2007, that he bought in 2007. So he sold it for $11,000. And so he had $1,000 gain, which was taxed at 15% long-term capital gain, plus an additional 3.8% of net investment income surtax, for a total federal tax of 18.8%. So the 3.8% net investment income surtax is another tax that comes into play when your modified adjusted gross income, or MAGI, exceeds $200,000 for single or $250,000 for married couples. So George and Martha owe $188 of tax on that gain from their sale of the stock, right? Which is 18.8, or do they? I gotta move this little guy up here. So remember, my definition of a tax is any cost that increases as your income increases. So any cost that increases as your income increases. So then George and Martha will owe more tax than $188 because the gain of the sale of the stock pushed them off this Medicare IRMA cliff. So now they're paying higher Medicare premiums. And this is one of those technical things that you probably want to come back to later. Or if you want to speak with me, I'd be happy to walk you through it a little bit in more detail. Okay, so let's take a look at how that IRMA event affected them. So this is the couple's Part B IRMA chart. That extra $1,000 pushed their adjusted gross income into the next premium tier for their Medicare premiums. So now instead of owing $349.40 each for their monthly Medicare benefit for Part B, they owe $454.20 a month, an extra $104.80, or $209 combined. For an annual total of additional income-related monthly adjusted Medicare premium of $2,515 for the year. Okay. Oh yeah, but it's not over, because now their Part D, which is the prescription side of Medicare, that is also impacted by IRMA. So George and Martha will each have another $20.50 per month added to their drug plan, an extra $492 a year for the couple. If you take all of that and add it together, it's just over $3,000 of combined additional charges for the year. So yeah, that's super fun, isn't it? So you'll see being pushed into that higher Medicare B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket, the last dollar, even a single dollar, is taxed at that rate. Whereas it's because we have a effective tax bracket. But when you look at the Part B and Part D income levels, even you could go over $1 or 10,000 and you're bumped up to these extra fees. We'll go over this real quickly, but another thing that I see a lot is people don't recognize the importance of applying for Medicare quickly, even though they may have an employer who covers their insurance. Okay, that's okay, Atul. I'll make sure to send you the recording. I'll talk to you soon. Thanks for joining us. So to help you understand, this is a story about Jim and Ann. They're both 68 years old. Jim retired at 65. Ann retired at 66. Prior to her retirement, the couple had health health insurance through Ann's employer. And they continued that after Ann retired because the employer offers retiree health benefits. Unfortunately, they didn't know that they had to also enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offered retiree health insurance benefits, those benefits are generally paid second. So Medicare, you need to apply for Medicare first because that is the first payer. And this couple didn't realize that. And so they made a mistake by applying too late. Thanks to the way Medicare enrollment periods work, they were not able to begin coverage until the following year. So they had to pay out of pocket. In the worst case scenario, this might result in a gap in coverage for either of them if they had a major medical need. But even the best case scenario, because they met the deadline to sign up for Part B, they will each owe 10% Medicare Part B base premium penalties for life. And you could see how that translates into real dollars. They have $420 extra in 2024. And historically, we can estimate that the premiums will be higher. So that 10% penalty grows. It stinks. So for simplicity's sakes, we're assuming that Ann's retiree health insurance covered her prescription drugs in this illustration. Okay. So we've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So you're probably thinking, wow, are there other tax traps in retirement? The rest of what we're going to cover isn't like what we've seen in Social Security tax torpedo or the Irma Cliff. The public generally isn't aware of those tax squeezes, as I mentioned, but this brings us to our third key topic. You must plan how and when you use taxable, tax-deferred, or tax-free assets to manage your income and tax brackets efficiently. That goes back to my strong belief that part of our job is to help people, our clients, pay the lowest taxes across a lifetime. So just a refresher, taxable account is like your bank account or a brokerage account. A tax-deferred account is like your IRA or your 401k or a 403b. And a tax-free account is your Roth IRA. And you can't be haphazard about tapping into your tax-deferred savings. Timing is everything. And if you don't plan through all the stages, you're gonna encounter unintended tax consequences. So the first question I hear from clients is, which account do we spend from first? So here's another story. This is Sam and Mary. They've been very good savers, as you can see, and we're looking forward to spending their retirement years traveling and seeing their grandkids. They have an IRA or IRAs that have $450,000 in them each. They each have $60,000 in a Roth IRA and $300,000 in a joint savings account. They want to spend about $8,500 a month, just about $100,000 a year. But the question I hear frequently is, where do we start? What's the best way? And again, everybody's situation is different. So remember that these are just concepts. Most people think they're going to first start with their after-tax money in the bank. And then they're going to do their tax-deferred IRA money. And then they're going to touch their tax-free Roth money. Of course, this makes a lot of sense. It's conventional wisdom. It's been promoted by many big investment firms for some time. It's not a bad plan, but again, everybody's different. Not surprisingly, this topic has drawn the attention of the academic research community in financial planning. So we're going to refer to some of these studies directly, which I'm kind of a geek on this stuff. I love it. So we're going to show how that conventional wisdom might not be ideal. Okay, here's an alternative approach. There are two key elements in early retirement. First, use up taxable bank money for expenses, but also during the same period, Accelerate your IRA distributions during otherwise low income years, putting that money into a Roth account. Again, these are concepts that may not apply to you, but they're just food for thought. What we're doing in those low income years is we're filling your tax bracket so that when the dollars in your IRA that have never been taxed before come out in a more tax efficient manner. Does it make a big difference? I do believe so. In these studies, the approach has been shown to increase portfolio longevity because it's going into out of your IRA and into your Roth. Any growth that happens in that Roth is never taxed. And of course, I don't do tax planning. These are just ideas. So everybody needs to talk to their tax professional for individual advice. And I'm doing that because Becky Gillette, our Chief Compliance Officer, is on and with us, and I want to make sure that I'm compliant. So one way to help manage your income before and during retirement is to utilize your Roth IRA conversions, as we've been talking about. In general, the amount that you convert is added to your taxable income for the year you take it out. So here's an example of Jill. If she converts $100,000 from her Roth IRA, from her IRA to her Roth IRA, she'll be adding $100,000 of income, and that income, that conversion income, is taxable. That's why we use the low income years if you have them. But what's really neat is a conversion process isn't all or nothing. Okay. One helpful conversion approach we call filling up the buckets. Often you may find yourself in the middle of one of the tax brackets and you've got room from the tax bracket you're in until the next level. Okay. So for example, in 2024, the 2022 tax bracket for married couples filing jointly goes from $94,301 to $201,050. If you're filing a joint return and your taxable income is $110,000, that means you have $90,000 of wiggle room till you're in the next tax bracket. And that's where we would work with your tax preparer to say, what do you believe the best amount should be converted? If you plan to convert a large IRA, this approach is often more efficient than converting the full amount one year. We like baby steps, okay? Any questions so far? I know I've got a couple minutes, 20 minutes here left, but I just want to make sure I slow down if there are any questions. Okay, so as I mentioned, Roth conversions are especially powerful in those low income years. It's common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. Maybe they've got a really good non-IRA savings account, and so they are not getting other income. And so in that low tax bracket, it's a good time to maybe convert IRAs. Also, it might be good if your retirement plan, maybe your 401k, allows in-plan Roth conversions. What we're really trying to do is reduce the amount of dollars that you're going to be forced to make distributions when you hit your retired minimum distribution age. Okay, so this is a good time to spell out the crux of things. You must know whether you're trying to keep income below a bracket threshold to avoid bumping into your next one. That's why we work with your tax preparers. So some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from your life insurance policies to keep income low. And again, your situation might not want to do that because you may need that life insurance for other things. Selling highly appreciated stock for low or no capital gains, taking distributions from an IRA or a 401k to take advantage of that year or those years where you're in a lower tax bracket. There are also two pre-retirement strategies to consider, but they don't apply to all people. The first has to do with what's called a health savings account, or HSA. This would only apply to people who have a high deductible health plan. The second one has to do with small business owners. Though those of you who want to be extra tax savvy and savings for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim something called QBI deduction, qualified business income deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits through retirement. If either of these apply to you, we're not going to dive too deep in this, but I'm happy to answer any questions afterwards if you'd like me to answer these. At the end of this workshop, there's a survey where you can fill out a little area saying, I'd like to talk about these things in detail. Okay, so here's another story. So we've talked about the importance of managing your tax deferred accounts because at some point you're going to be made to take money out. Many people make charitable donations, maybe to Lollipop Farm or to your church or whatever. So in this situation, we're going to talk about Albert and Shirley. They're in the 24%. Oh, I'm such a mouth breather. I'm sorry. They are in the 24% tax bracket. And now the standard deduction for married couples in 2024 is $29,200. But Albert and Shirley are over 65, so they each get an additional standard deduction that roughly totals for 2024 $32,300 because they're over 65. This means that they will receive no tax benefit for any itemized deductions that exceed $32,300. So if Albert and Shirley have $15,000 of existing itemized deductions saved for maybe state or local taxes, maybe deductible medical expenses, mortgage interest, whatever, what happens if they want to, tax-wise, donate $5,000 to charity? They won't get any benefit. They can't deduct that. That's not saying they shouldn't, but there might be a better way to do it. Okay. Now, if you're 70 and a half and you have an IRA or an inherited IRA, there's another way, this is the other way, to give to charities other than simply writing a check. And it's something called qualified charitable distribution, and we call it QDC. So let me explain how this works. It's very powerful. We have a handful of families that do this, and it's very useful for them because they've been exceptional savers. So first, some rules. If you're 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both are over 70 and a half and both have an IRA, you can each make $100,000 in qualified charitable contribution from your IRA. Second, any qualified charitable distribution you make counts towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to that qualified charity. The check cannot be written out to you. There's a process. We're really good helping you with this. So why would we suggest doing this when you don't get a deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from your IRA is never counted as income. So let's see how that helps Albert and Shirley. Okay, so let's say in this scenario, they do what Albert and Shirley do, what many people do in retirement. Albert takes a required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. I swear to God, you guys, I know how to speak English. Sorry. So Albert took the required minimum distribution and deposited it in his bank, and he's done for the year. Then he's like, oh, I want to give $5,000 away to charity at the end of the year. The end result is that the charity gets $5,000. Everybody understands that, right? But let's look closely. By virtue of giving to a charity this way, Albert and Shirley, their $5,000 charitable contribution, that costs them $6,200 because they're in that 24% tax bracket. No good deed goes unpunished, right? Okay, so let's do it a different way. This is how we do it a ton. So instead of requesting the $5,000 distribution from their IRA to their bank account, what Albert should have done is ask, like if he were our client, he'd ask us to transfer the $5,000 directly from his IRA to the charity. He never receives it. And that satisfies his required minimum distribution because now he's over 73. So the charity gets $5,000 and Albert and Shirley don't pay any extra in taxes. And by the way, I don't have anybody that wants to take $100,000 out of their IRA and give to charity, but that's, you know, I do have a relationship that has a $9 million IRA because he worked at U of R until he was 83. And you should see that required minimum distribution. So that tax bill is a big bill. Okay. So how does retirement tax planning figure in? It's a very good question because the government still wants its money. So let's talk a little bit about our final point. And I know we've got 7 minutes and I've got a couple slides here, so I might run a little long, but I'm gonna hoof it here. So how do you organize your assets for your family's benefit? So estate planning is critical. And when you, okay, let me rewind a little bit. We're not gonna discuss giving to your family in a traditional way because the new law excludes estate valued over, okay, 13.61 million in federal taxes. So I don't know anybody who has that kind of money, but it's still very important to remain focused on how your beneficiaries receive those dollars when they inherit them. So if you're a married couple and you plan to give to your children and you have a non-IRA, when you pass away, your children will receive a new what's called step up in basis. And what that means, like if you bought AT&T for $100 and when you died, it was worth $900 and your kids receive that as an inheritance, their new basis is that $900. Okay. So in this scenario, I'm trying to make this so I can get this all done for you guys. So Phil and Mary, they live in separate property state. They married, meaning not a community state, which New York is, this applies to New York. They're married and own a variety of taxable investments in a joint brokerage account, and it has long-term gains of $120,000. So when Phil dies and Mary will receive that his portion, a step up, $60,000 step up, which is important because now she has, if she needs to sell something, her long-term capital gains are lower. Okay, so now let's suppose upon Phil's diagnosis, Mary and Phil move to investments into one account just under Mary's name, which there's no look back on that for a spouse. So we put, sorry, in Phil's name, Phil dies, all of those dollars are now, they receive that full step up. you know, when you sell your investment, would you rather owe taxes on 60,000 of gains or none? So that's the reason for this planning piece. So maybe you've got, you're someone who's managed to save up quite a bit in your 401k and you feel pretty confident that you're comfortable in retirement. And you leave an IRA to your children. So we're going to talk about that next. So in this first scenario, Pamela and her son Kyle, those are the two people we're going to talk about. Pamela unfortunately passes away when she's 70, leaving a full IRA to Kyle. We know that Kyle has a maximum of 10 years now to withdraw that IRA money to keep required minimum distribution rules. And we're going to assume that Kyle, that inherited IRA, earns 6% annually. So he's going to have to take $54,000 out of that IRA, which, if he's working, increases his earned income, his taxable income. So in the second scenario, so Kyle did not take $54,000 a year, and this account grows, and on the 10th year, he has to take it all out. Man, that's a whopper. That's a big tax bill. I am going to skip through long-term care here because we're running out of time. Unless anybody has questions about long-term care. Okay. So I know that this is a lot of information. And like I said, this is being recorded, so you can always come back to it. You're going to get some great handouts that kind of help you get organized. And we really started from the beginning, just to recap. Retirees often pay more taxes than expected because of a confusing tax system. There are these 4 stages of retirement: when you're early retirement, or pre-retirement, early retirement, mid-retirement, and late retirement. The things you really need to think about are, what's the best way to deal with your income in an after-tax manner? Because your tax exposure will change throughout retirement, we need to think of the strategy like this. You're going to need to anticipate how and when you tap assets to cover your personal expenses. Understand the range of taxes you will face at various ages, and manage your actions so that you pay the lowest amount of tax possible. Okay, so we've talked about distribution phase, how to manage taxes throughout your retirement. Hopefully you don't make any mistakes, because they can be costly. And we, as a firm, we really focus on educating our clients so that they understand the implications, which is why we do these seminars. And we're really glad that you guys came. What I'd like to do is have you guys take the survey as we end, and I'm right on time now. There's a piece called Request a Tax Retirement Planning Overview. This is a complimentary 1-hour service. I charge $350 an hour. But if you're a client, of course, that's included in your fees. During that meeting, we can talk about your retirement and your savings needs, the roles that taxes can play. Also, maybe identify ways that you can, you and your family can plan across your lifespan. Coming out of that meeting, I promise you, you will leave better off than you showed up, and help you become better informed on retirement planning. You're also, at the end of this survey, you're going to get what we call the guide to taxes and your retirement. You'll see that. And of course, I'll be available for any questions you guys might have. Any questions at all? Thank you. Really appreciate it. Grateful for the participation and the feedback. If you guys have time to fill out the survey, that would really help us make sure that we're on track, or if we could do or present in a better way, or maybe some topics that you you might have for future presentations. I'm 1 minute over. I can't believe I got through all of that.
Thanks, everyone.
Thank you, guys. Be well and be safe. Enjoy the weather.